Back a while ago, we offered $10,000 if anyone could prove us wrong. I'm gonna tell you more about that at the end. The main point I wanna talk about is when I saw what happened to the NASCAR driver, Kyle Busch, it punched me in the gut. If this can happen to a multimillionaire with a team of advisors, if they can get absolutely wrecked by the wrong life insurance policy, what chance does the average person have? I mean, because this could happen to anyone. Life insurance is confusing. Policy illustrations, riders, index credits. What most people don't know is what they're actually buying. And that's how people get hurt. Before we talk about Kyle, you need to understand what got him and his family in trouble, because it's the same thing that's happening to thousands of people. They're being sold an indexed universal life policy. Now, I'm not saying that the policy itself is wrong, but how it's being sold is. IUL has an increasing cost of insurance. The companies can raise these costs at every time. In the contract of the IUL, this is stated. The index growth, the participation rate, is not real market gains. It's tied to an index. You're not actually investing in the markets. And in some IULs, the upside, what they call the cap rate, is capped. You can only get so much upside. The downside is what's mostly sold. They say you can't lose money, but that's not true. Because even though you can't lose money on the participating rate, you can lose money because there's a cost of insurance, commissions, and other fees. And if the returns don't outpace the costs, well, the policy can collapse. People actually think that index universal life policies work as a banking tool because they're being sold wrong. It's not. It is a hypothetical gamble, wearing an insurance costume. That's all it is. And the Kyle Busch story outlines all of that and literally points to the problems with these policies. There's tons of articles about this. So let me be serious with you. Kyle and his wife, okay? They're multimillionaires. They paid in roughly $10.4 million into one of these IUL policies. They believed it was safe and they believed it was self-funded because they were told that after 5 payments, 5 years, they could stop funding it. And then they were told they could take out about $800,000 a year tax-free as retirement income after their race career ended. I think they said 52 years old, but that wasn't entirely true. They were pitched a tax-free, fail-proof retirement plan. And it was sold to them by a trusted insurance agent. The 6th premium payment notice appeared in their mailbox, and it was unexpected. They didn't think they were supposed to get any more. Apparently, they got the runaround when they started asking questions to their agent. The Busch family got a third-party independent review of their policy. And what the articles show is that the policy would lapse sometime around the 16th month after they stopped funding it. Or maybe it was after they started taking income. But the cash value would be nearly wiped out. That means that over $8.5 million of net out-of-pocket losses, that's what they'd have to face. So they're alleging misrepresentation. They're alleging negligence from the agent and the insurance carrier. They're alleging deceptive sales tactics and hiding the policy's complexity and volatility. I talk about this all the time. I mean, just imagine thinking your family's safe, thinking that you've got this retirement income that literally is almost fail-proof, because that's what the Busch family thought they had bought. That's what they were technically sold. And you know, I've done multiple videos about IULs. I've dissected the contracts. I've shown everybody what the language means. I've showed them how the illustrations aren't what you think, because you cannot receive a steady level return from a market-based participation rate. The markets never give you the same return, but how these are sold is on an average return. Now, if you're taking an income and you're taking money out of one of these policies, there's a lot that is not explained. And clearly, that's what happened here with the Busch family. So when they got that third-party review of their index universal life, the person who reviewed it, who I don't know, or I don't know what company it was like, no way. That's not how this operates. This is what's going to happen. And you know, what was going to happen was outlined in their illustration, but it was buried in so much legal mumbo jumbo, and the illustration was very difficult to read. I have a difficult time understanding these illustrations. So how would you or the average person understand the legalities in these IUL contracts? You see, I'm very used to whole life insurance and whole life insurance contracts. Some of the language in a whole life insurance policy can be a bit complicated, but nowhere near as complicated as an IUL. The most important thing you need to understand is an IUL, an Index Universal Life Policy, is by design meant to take the risk off the insurance carrier, put it on you in the sense that you're dealing with a hypothetical market-based participating rate that can and more than likely will change. You're dealing with hypotheticals, not guarantees. You're dealing with a rising cost of insurance. Every year you get older, the cost for that insurance, that death benefit, goes up in an IUL. In a whole life insurance contract, the cost of insurance is level from the year 1 to year 121. That is not the case in an IUL. There are so many things in an IUL contract that people like the Busch family need to understand, because all the things in the contract, for the most part, can be changed, because it takes the risk off the insurance company and puts it onto you. In a whole life insurance policy, you're shifting the risk to the insurance carrier through guarantees, contractual guarantees. Now listen, I'm not here to make a point of whether a whole life or an IUL is better for you. I'm simply pointing out that IULs, for the most part, are sold wrong. Not always, but in this case, in the Busch family case, it was definitely improperly sold on hopes and dreams that never were going to materialize. Now listen, Kyle has resources. He's got attorneys, he's got advisors, and he still got burned. The average family doesn't stand a chance. Let's be really clear about something. The infinite banking concept is not an investment. It's not about chasing returns, and it's not a retirement gamble. It is a system, a process, and one built on controls, on guarantees, and one built on compounding interest. It takes back the banking function in your family's life, period. Let me go over that again, and then I'll give you a visual. You deposit money into the policy. You borrow money from the general account of the insurance company. You deploy that money somewhere where that money will earn a rate of return, and then you recycle and recapture that money. You be an honest banker. You don't steal from your bank. I'm not trying to yell at you. I'm just trying to get you to understand this isn't magic. It is banking. It requires predictability and stability, not just on the insurance policy, but on you. It requires guaranteed costs, not rising ones like you find in an IUL. It requires guaranteed compounding interest, not performance assumption and participations in hypothetical returns. It requires liquidity, not projections. You see, a real private banking system cannot run on maybes. It must run on certainties. You got to keep it simple, folks. You have to understand that IULs come with uncertainties. They come with risk that many people do not understand because they are not sold IULs properly. And one other thing that you really must understand is the third law of wealth. You must invest in things you know, like, and understand. If you don't know, like, and understand the contract behind an IUL, be cautious. Get knowledgeable about it. Read the contract over and over. Ask difficult questions. These are all things the Busch family clearly did not do, and most people that buy IULs do not do this. Simply put, don't get fooled by the hype or some fancy sales pitch. I want to explain something. I want to explain why a specially designed and engineered whole life policy is the right tool for the infinite banking concept. This is the part that most people miss. The infinite banking concept only works with one thing, and that is a properly structured, high cash value, dividend paying whole life insurance policy. Guaranteed level cost of insurance. Your costs never rise. There are no surprise increases. There are no collapsing policies. You need guaranteed growth, which comes in the form of a contractual guaranteed interest rate. And then the dividends in a whole life also help. They're steady, they're predictable. They help with the compounding interest. Even though they're not guaranteed, they have never not paid them. These are mutually owned companies that share in the form of dividend crediting rates. The uninterrupted compounding nature of a whole life, that allows your money to grow even when you borrow against it. This is called non-direct recognition. That's very important. You want a non-direct recognition company. The other form is a direct recognition, which means they directly recognize the loan, which means it's going to hurt you if you keep the loans out. So one of the things you've got to be really understanding about To use the infinite banking concepts, the IBC Practitioners Organization and the NNI states that you want a whole life insurance policy from a mutually owned company that pays dividends. And these should be specially designed and engineered for high early cash value, which means the agent or advisor that builds the policy, like us, what we must do is build it so that we reduce our commissions. It's the only way it works. By reducing our commission, that allows for the client to have more high early cash value. And now all those things I just mentioned do not exist in IULs. Matter of fact, the NNI, not to preface them, but in the manual, in the trainings to become an IBC practitioner, it states you cannot use an index universal life with the infinite banking concept. Now, granted, I'm not saying you can't use an IUL. You could use an IUL for different use cases. They work pretty well for premium funding or premium financing, and there are other use cases where they work, but they do not work for the infinite banking concept. That is why we use whole life insurance. And I'm going to wrap this part up with this. Inside a whole life insurance policy, there is a guaranteed column and a non-guaranteed column. Okay, that is it. They're very simple. There are not a lot of moving parts. The difference between the guaranteed and the non-guaranteed is only the dividend. If the insurance company does not pay a dividend, then you are on the guaranteed side. But these insurance companies, all the ones we deal with, which are 5 mutually owned life insurance carriers and large ones, they have never, ever not paid a dividend. That means they paid a dividend through the Great Depression, through the Great Recession, through all the recessions and the world wars, everything, they've always paid dividends. So when you look at the non-guaranteed columns, although they can change because dividends can go up and down, they've been going up the last couple of years, and this is 2025 just for reference, they are not guaranteed, the dividends. The guaranteed interest in the contract is in fact guaranteed, and it never changes and it cannot be changed. These are important things to consider. An IUL gives you a guaranteed column and a non-guaranteed column as well, sometimes a midpoint. If you look at the non-guaranteed, they're showing you a hypothetical participation rate, and they are showing that rate like you would get it every single year. That is not how indexes work. I've never in my life seen an index get the same return year over year over year. It goes up, it goes down, it goes up, it fluctuates. That's how the markets work. So right from that standpoint, an IUL is flawed from the beginning. In the small print on your illustration and the small print in your contract states that it is unlikely that you will receive these returns. I did this in a wealth webinar that is on my YouTube channel where I read these disclaimers. I read this language on an IUL policy I had designed for myself. Listen, just do your due diligence. Just invest in things that you understand, you know, and you like. I'm not saying you shouldn't like IULs. I'm just saying, do you understand them? The other thing you must understand is liquidity is very important. Inside a whole life, you have liquidity for whatever the cash value is. Inside an IUL, there's 2 columns. There's your cash value and then your surrender value. Your liquidity is based on your surrender value. You must understand that when you're looking at it, the agent or advisor might only talk about that non-guaranteed cash value. It's the surrender value you need to look at. You want the maximum cash value that is designed for liquidity, not just death benefit. You don't want your policy tied to the markets, and you don't want to deal with cap rates and all these things that can change. You don't want to deal with participation limits or participation rates. You don't want to deal with volatility of the markets. You don't want to deal with collapsing cash values because rising costs. This is just my opinion, but in my opinion, Index Universal Life, they're investments. They're tied to an investment, but they're not sold as investments. They're disguised as insurance. Whereas whole life insurance, when properly designed, can work really well for private banking. So earlier, I had mentioned that we offered $10,000. Let me dissect that, okay? Back a while ago, myself and Chris Kirkpatrick did a challenge. We did a challenge and we stated that if anyone could show us an indexed universal life policy that was 10 years old or older, and then show us a current in-force illustration that beat the original 10-year-old illustration. So in other words, a policy that was set up 10 years ago, an IUL policy, and then you show me an illustration, an in-force illustration today that beats the original illustration that was done 10 years ago, we were offering $10,000 for that. Because here's the thing. Why did we say 10 years? Well, because 10 years is the longest bull run we've ever had in history. So if during a bull run, like some of the best market performances you've seen, if you can't beat what you showed 10 years ago, the hypothetical participating rate, if you can't beat that, then why would anyone put money in these? That was our challenge. You know, to date, no one has brought us that illustration that beat the 10-year-old one. No one has come forth. Now, everybody says they have that. Everybody says they're going to do it. And why wouldn't they? That's $10,000. If you offered me 10 grand and all I needed to do was go in and find the old illustration and show you a new one that beat it and be like, hey, give me my check, I would do that. But no one has done it. Why would they not do that? Well, because nobody has that. My understanding would be that there is not an agent out there who had an illustration, a current in-force illustration that beat the 10-year-old one, because these products are sold wrong. They are flawed at the core. And we put 10 grand up to prove that. And so far, we're right. Now listen, I want to be clear. I have many IUL agents, and I call them friends. They do right by their clients. They offer whole life, and they also offer IUL to their clients. And you know what? They do it right. They don't sell it wrong. And they are out against IUL agents selling it wrong as well. Because listen, after what happened with Kyle Busch, I think you understand why. And if you don't, do your due diligence. I encourage comments. I encourage all of you to put a comment down below. But please, if you're going to put a statement in there, back it up. Because I'm going to come at it from a debate standpoint. I'm going to ask really hard questions. And hey, look, if you enjoyed this video, then throw a like down below. And also, there's a little button right here. It says subscribe. Hit that subscribe button. Now, there's a little bell up top. What I'd like you to do is I'd like you to see that little bell right here. Yep. Smash that bell so that you're notified every single time I put out new content. And if any of you want to learn more about the infinite banking concepts, or you want to set up one of those specially designed whole lives, then schedule a call with my team. And you know what? Ask questions, drop the comments below, jump on a call with us, and I hope you enjoyed this episode. And stick around for the next one right here, The Secrets of the Wealthy. Thanks for watching.